Hey traders, and welcome to this Forex Masterclass where we're not only going to dispel some of the myths around Forex trading that, to be honest with you, is probably the reason that you haven't been as successful in your FX trading as you would have liked to have been so far. But I'm also going to give you a framework for trading these markets that's really kind of going to stack the odds in your favor and in fact allow you to make money even if you get it wrong sometimes in your entry or your overall direction of the markets. You see, the FX markets, they're unlike any other market out there. They don't tend to move the same as other financial markets, and part of the problem that a lot of people have when they come to these markets is that they believe that they do. So they use the same sort of technical trading approaches, the same strategies that they would apply to other markets, and then they wonder why they don't make money trading the Forex markets. And in this presentation right here, I'm going to show you exactly why that is, and then going to give you the framework, as I said, that's going to allow you to make money in these markets. Now, a lot of people look at the Forex markets and they think that, they're the markets that trend. Well, that's the propaganda anyway, right? It's like, come to the Forex markets, they trend really, really well. They've got loads of momentum and things like that. And whilst they do trend to an extent and there is momentum there, and in fact, it's probably the easiest market to learn to trade out there, it's not for the same reasons as a lot of the Forex brokers would have you believe. So in this presentation right here, we're not only going to give you that framework, but we're going to give you proof that these markets don't trade the same way, because it's really important that you understand this to be able to be successful in the long run. So what I would ask you to do is pay attention to this presentation through its entirety. So even if you feel like you know some of it, please give me the opportunity to talk you through my perspective on things, because it might be a little bit different. I might have a little bit of a different take to yourself on things, and that is obviously going to help you with the understanding of the framework at the end when I teach you the strategy and the framework for trading these markets. So please kind of stick with us to the end. Keep an open mind as well, because some of the things I'm going to talk to you about here is going to go against conventional wisdom for trading these markets. But if you're worried about conventional wisdom or the fact that it will go against conventional wisdom, just look at that statistic at how many people actually don't make money in these markets. And then say to yourself, well, all of these people are following the same approach. If they're all following the same approach and not making money, then maybe the approach that Alex is about to show me right here, which goes against all of that, does sort of go against the grain and is different, maybe that is the way to make money in the markets. In any case, I'll leave the decision up to you. All I ask is that you keep an open mind, you stick with us till the end of the presentation here. You allow me to show you all of the evidence and show you the framework and the way to trade these markets. And then, as I said, you can go away and you can draw your own conclusions. So with that being said, please enjoy this presentation here, and I'll come back to you at the end to talk to you a little bit more. Okay, so welcome to the workshop where we're going to attempt to show you why you haven't been making money trading the Forex market so far. And then we're going to give you a framework that's going to allow you to go out there and start to generate consistent profits from your Forex trading. And what we're going to teach you is based on 32 years combined experience trading these markets. So you're going to learn an extremely consistent and profitable approach to trading these markets that's based and built off of the fact that actually the Forex markets, they don't trend, or at least they don't trend the way that you think they trend. But first of all, I'd like you all to get rid of all of your distractions. So this isn't going to be a workshop that's going to last hours and hours and hours. We're going to spend, maybe 30, 40 minutes where I'm going to provide you with the proof that you need. And then I'm going to give you the framework that you need to go away and start generating profits. But what you can't do during this time is sit there, watching or checking your emails and other things. Just kind of dedicate the next 30 minutes to this workshop right here. I promise you, you will not be disappointed. Now, typically in the FX markets, we have an opportunity to make money every time the market moves up or when it moves down, right? That's essentially how we make money as traders. We make money from the volatility of the markets. The difficulty is identifying these moves before they happen. But I have a question for you. What if you don't have to? What if I could show you that actually there's a better way of trading these markets where you're not really bothered about when the markets move, because you're trading a framework that allows you to make money in every eventuality. So for example, when the market moves sideways, when it moves in your direction, and even when it moves against you, you'll be in a position where you can generate profits. Well, that's what we're going to do in this webinar right here. I'm going to show you how you can do that. But before we do that, I need to show you, the basic theory behind the framework that we trade, because it's really, really important that you do that. And everything that my brother and I will teach you, we're always going to show you the why. We're not just going to give you a black box and say, go and do this. We need you to understand why something's put together, why something works the way that it does, because we believe that that's ultimately going to translate into more consistent profits and a better trading experience for you overall. So our general idea, or our theory is that the Forex markets, they don't trend, right? One of the big appeals of the Forex markets is the fact that they trend really well. Well, that's the party message, and most beginner strategies are actually built around this premise. Now, whilst there is volatility in the FX markets, there's no denying that, and there is directional volatility as well. They do not trend like other markets. In fact, data shows that the Forex markets, they move less in percentage terms than most other markets. And therefore, to be successful in the long run, you have to build an approach that not only accepts this fact, but embraces it. And to put this theory to the test, to kind of really prove this to you, so it's not just us saying this for the sake of saying it. We want to show you that actually what we're saying, is true and it does have an impact on your trading. We did a bit of a study. We did some analysis into the directional volatility of the FX markets, and we compared it to other markets. And, we weren't surprised by the results. I mean, we were a little bit surprised that we were so right, but we weren't surprised by the general results. And we'll show you what they are right now. So these are the Forex markets versus other markets. Now, before we look at the numbers, let's just take a moment to appreciate why it is that the currency markets, they can't trend like other markets. And this is due to the fact that essentially you're trading one country's economy against another country's economy, right? And for a long-term meaningful trend to emerge, a serious and sustained imbalance between the two countries' economies needs to occur. Right? It's just a fact. That's what needs to happen for us to be able to have one of those, big trends like you would see in the stock market. So, if you look at Amazon, for example, and you see the way that their stock price has gone over the past few years, you're never going to find that in a currency pair, because there are economic cycles, right? So it goes back and forth. And yes, you may get some trends emerge, but eventually there's going to be this sort of reversion to the mean type dynamic that you see across most currency pairs. And I say most because there are one or two where you will see more sustained trends. So things like the Swiss franc or the Japanese yen, which are more safe haven type currencies. So when you see, periods of economic expansion across the globe, and you have a country like Japan, for example, which has interest rates near zero and has been that way for a very, very long time. Well, that's conducive for a currency that will go on a big and sustained trend. And we'll go into that a little bit later. But that's all to do with the carry trade and the relationship between interest rate differentials. So the Swiss franc and the Japanese yen are a little bit different. They still do have that cyclical nature about them. But when we look at things like the Australian dollar against the US dollar, or the euro against the dollar, or the dollar index in general, you'll see that actually there is this sort of reversion to the mean type dynamic. And even when you get, directional volatility, it's not sustained. Okay, so if we look at the charts that you can see in front of you here, what we've got the dollar index on the left, we've got the Aussie dollar, so the Australian dollar against the US dollar, we've got the euro against the US dollar, then we've got the S&P, we've got gold, oil, and then we've got a few stocks there at the end. And what we want to demonstrate to you is the difference between in percentage terms that these markets move. So if you look on the left, you'll see the dollar index, and you see that this moves least of all. So this move right here, if you take a look at it on a 1 month basis, so each of these stocks and the currencies you've got there, we've got the 1 month, the 3 month, the 6 month, the 1 year, and the 5 year. Okay, if you look at everything on a 1 month basis, you'll see that the dollar index is close to 0.00%. The actual number is somewhere around 0.05% or something ridiculous like that, right? That's what it would, and this is a comparison over sort of 5 years worth of data. This is what the dollar index moves on a monthly basis. If you then extrapolate that out and you push that out to 3 months, we can see that, yes, it moves a little bit more, but, we're not setting any records here. We're looking at still, a return of around less than 5%. If we then push that out to 6 months, also less than 5%. 1 year, it goes up to just below 10%. And then crucially, okay, after 5 years, it then drops back down again. So what we're looking at here is we're looking at, where the market goes from a particular point in time. So from day one, and then push that out to a month, where is it in percentage terms? And then where is that after 3 months? Where is it after 6 months? Where is it after a year? And then where is it after 5 years? And what you can really see here is that first of all, the markets don't move a great deal on a month-to-month basis. But even when you push that out over a year and then go over the 5-year return, you can see that the 5-year is actually less. And what that shows you, what that's illustrating, is the cyclical nature of these markets. So after a year, yes, the dollar index may appreciate by, let's say, 10%, but then 5 years' time, it's then retreated again as the different economies of the world go through their different economic cycles. If you look at the Australian dollar, you can see the same thing. So the return there's a little bit better. On a month basis, it's still towards 0%. In fact, the average across all of the currency pairs was about 0.07% on a month-to-month basis. Okay, you look at the Aussie dollar. The 1 month is 0.0 something percent. If we go out to 3 months, we can see it's just under 10%. 6 months, it's also just under 10%. 1 year, it ekes out above 10%. And then when we get to the 5-year mark, it's then retreated again. And you can see the same thing in the euro dollar as well. Now, if we go to look at, let's say, the S&P 500 or gold or oil or one of the stocks, on a month-to-month basis, the return, it is higher. It's definitely higher. So if you look at the average on the right-hand side, you can see that whereas with the currency pairs, they're at the 0.0 something percent, at least with the S&P 500, with gold, with oil, you're looking at 0.5% and above. And then when you get to the stocks, you're looking at 2 to 3% monthly returns. But what you can see with all of those there, okay, barring oil, which is also a little bit more cyclical in nature, but what you can see of the S&P 500 with the stocks there is that as you go further and further out into the future, the percentage return increases. So they don't really have that cyclical nature about them that the currency markets do. And that's really important when you're trading these markets because it will have an impact on the way that you want to approach your trading. So for example, if you try to just trade a trend following approach or a buy and hold approach trading these markets, it's not going to work. I mean, you might get a little bit of return. If you apply some leverage there as well, you might get a little bit more. But generally speaking, if you want to make a decent return from the Forex markets, you have to embrace the fact that they are volatile, but they're not necessarily directionally volatile. Okay, and there's a fantastic way to make money trading these markets based on this fact right here that actually you don't get with the stock market. So the problem if you try to trade the stock market and you got the wrong direction is it might never come back, right? So you can't apply a sort of like an effective risk management framework to the stock markets the same way as you can to the Forex markets, because with the Forex markets, you have this cyclical nature about them. Now, to back up what we've said, we also looked at how the Forex markets move when they do trend. So when there is some directional volatility there, we wanted to do a comparison. And whilst obviously the percentage change, so from a high to low is slightly better. So you can see here from a high to low of the dollar index, we're looking at 1.75%. The Aussie dollar is nearly 3%. The euro is just above 2%. If you look at things like the S&P 500, oil, gold, and some stocks, it's still significantly more. So it doesn't matter which way we try and dice this. It doesn't matter which way we look at this. And the currency market's volatility from a directional perspective is nowhere near that from the stock markets. And if you're sat there thinking, well, there's no point in trading the FX markets, actually it's completely the contrary. So because of this, the FX markets are actually a lot easier to trade than the stock markets because you can build a framework, which is what we're going to give you here, based on the fact that there is no directional volatility and based on the fact that there is a reversion to the mean type strategy. And actually, there was a very successful hedge fund back in the 90s called Long-Term Capital Management. They eventually imploded because they didn't have very good risk management, but we've fixed all of that with our particular framework. But this hedge fund for a period of time was one of the most successful on Wall Street And that was based on a strategy, a framework that is similar to what we're going to show you here today. The only difference with what we're going to teach you is the fact that we've taken into account risk management. So we're not just assuming that everything will revert to the mean. We do have some things in place to make sure that we mitigate our risk. And finally, before we do get on to looking at the strategy and looking at how we trade according to this particular belief, I just want to give you one more little bit of proof, which is this Australian dollar against the New Zealand dollar chart, which is a 5-year view. And what I want you to notice from this is that in 2016, the price started at somewhere around the 1.06000 mark. And then all the way in 2021, so where we are right now, the market is at 1.0727. Okay, at the time of recording. So what we're saying here is that yes, there was some movement up and down. So it went up to 1.1200. It came down to 1.0000. Okay, so the nice big round number there. But where we are right now, we're almost where we were 5 years ago, which just kind of further demonstrates the cyclical nature of the currency markets and something that you have to embrace to be able to make money, okay, trading these markets. Now, to do that, you are going to need a complete paradigm shift. So most retail traders, they lose money because their approach to the market sets them up for failure. In order to be successful in the long term, you've got to change the way that you approach your trading, particularly with the Forex markets. And what I mean by that is you have to learn to embrace the randomness of the markets. Okay, you have to learn to understand that your entries into the markets are not what's important. It's actually your exits, okay? Particularly with the Forex markets. And I keep saying particularly with the Forex markets, but it's so very true, okay? So with these markets right here, there are so many different participants in the markets that you're never going to be able to know what the next move is going to be. So if you try to predict where the market is going to be in the next 15 minutes or the next 1 hour, some of you will be able to do it, but it's a lot more difficult than trying to predict where it's going to be in the next day, the next week, and the next month. And in fact, there was a study done by a Forex broker quite a few years ago now where they looked at their customers' accounts and they wanted to find out how many of their customers were right on the direction of the markets from where they initially entered their trade, not whether they made money, because most retail traders, they trade without the knowledge that we're giving you here and they lose money. Okay, but they just wanted to see were they right on the direction. And what they found is that as they pushed the time period out, so they went from the time that they entered their trade, whether it was a buy or a sell trade, and looked at where was the market after a day, where was it after a week, and where was it after a month. And what they found was that as they went from a day to a week to a month, from a month to 6 months, they were more and more accurate as the time period went out. Okay, and more of their customers were obviously got the direction of the markets right. So what we have to do, our jobs right now, is to trade according to a strategy that understands that there are different participants in these markets. So you don't just have hedge funds. You don't just have speculators looking to make money. You've got large corporations that might be repatriating some of their funds. So, for example, you might have Sony that needs to take profits, book their profits for the year. They've been selling PlayStations in the US, so they need to change their US dollars for Japanese yen at some point, and that's going to create a currency transaction. That's going to create supply of US dollars and demand for yen. Okay, and that's going to have an effect on the dollar-yen exchange rate. So if we know all of this, if we know that there are these different participants and there's no way for us to know when they're going to enter the markets, and will be more accurate the longer the time horizon is, then we really have to learn to embrace randomness and build a trading framework around that, which is what we're going to give you here. But everything that we do, we believe as educators, right? So my brother and I, when we're putting out a strategy out there, it's important to create strategies and frameworks that are easy to understand and follow, whether you're brand new to the markets or a seasoned veteran, all right? And to ensure the strategy satisfied this very important criteria, what we did is we selected a random group of people to test our trading framework. And the results, they surprised even us. So what we're about to show you right now, okay, is astounding. All right, the framework that we're going to give you is so powerful, and I'll show you why. So when we did this test, we'd expected that most traders were going to do well. As the framework is robust and it caters for all types of traders. But as we know, In the typical retail market, so before you understand the framework that I'm about to give you here, 95% of all traders, they lose money in the markets. And to alter this statistic from our perspective just a little would have been a great thing. But when every single tester came back to us with their final results and reported that they were in profit, we were actually shocked. We were expecting, at least some of them to have lost money, but that wasn't the case. Statistically, at least one of them should have lost money, but every single one of them came back and reported a profit at the end of the testing period. And if that wasn't enough, the next statistic is really, really, really going to blow your mind, because most of the traders reported a monthly gain of around 6%. That's an annualized return of 72% trading with only very, very small position sizes. And one of those testers wrote this. They said it's a low risk, low stress system. Okay, so they said that this is the safest trading system that I've ever come across. Trading always involves risk, but this system uses natural harmonic movement in price action to capture profit whilst cleverly managing risk. Using this system to execute trades combined with basic technical and fundamental knowledge will almost certainly grow your trading account. I've never traded with such a low level of stress and high level of confidence. And that is so important, guys and girls watching this. Okay, trading with a low level of stress and high level of confidence is what you want. That's like the magic combination right there. He then goes on to say, I only need to check the trade progress twice a day, once would probably do, and set up new orders every 2 to 3 days as live trades close so that I can maintain a portfolio of 4 to 5 positions. I've banked 650 pips and my trading account has increased by over 6% per month using this system from a standing start, and I've not had any losing trades so far. And whilst he hasn't had any losing trades, I'd kind of caution you to ignore that because you are going to have some losing trades at some point. This is just this particular gentleman's experience of it. And I'll show you some other people's experience of the framework later on. And you might say to yourself, well, why is it important what this person says? And it's important because, as you know, and I know, when you're looking to trade a trading system, it's okay me telling you how something works, but you want to know how other people like yourselves have fared with a particular trading system. Okay, because if a professional can do it, that's all well and good, but we've got the benefit of years of experience and, and knowledge and understanding of the markets. People like yourselves that are watching this probably don't have the benefit of that experience. So you want to know what another sort of like average person off the street, how they fared with the strategy. So that is why we're giving you this information here, to really give you the confidence that the strategy that we're about to show you is the real deal and it works for real people. All you have to do is you have to put it into action. Okay? Now, there's a myth in the retail markets that retail traders, let me try and restructure it. There's a myth in the markets that entries are everything. Okay? Retail traders obsess over entry points. They're convinced that if they can just perfect their entries, they'll be able to make money. And there's this famous saying in the professional trading community that it isn't where you enter, it's where you exit. A great example of this is the role that a market maker plays. So a market maker has to provide liquidity to the markets, right? Which means that they have to take on positions that they don't necessarily want, and then they have to manage their way out of it, which really proves that entries are not everything. And we've got a friend who works for a very, very large bank, and his job is literally to manage his way out of positions that he doesn't want. So he has to make a market for his clients. Sometimes he'll be able to hedge some of his risk. Other times he won't be able to. But essentially, he's got to take on that customer's position. And when he takes on the position, he's then got to find the best way out of it and hopefully make a bit of money for his desk, right? That's what his job is. So that kind of proves that whereas retail traders, they focus on the entry points, entries aren't everything. And in this framework, we're going to prove to you that you can make money even if your entries absolutely suck. Because how many of you have taken trades like this? So look at this chart in front of you. You can see where we've got the green circle there, where we've highlighted it in green, that the market's been moving up. And maybe you're trading a trend following breakout system. You decide to take a break of a high. You place your stop below the low. The market quickly goes against you. And then the market goes off in your direction and you're unhappy because you haven't been able to make money there, even though you were right on the direction of the market. You were just a little bit wrong on your timing. How many of you have been in that situation? Right on the market, right on the direction, timing sucks. You took the position, you got stopped out, and then you saw the market go off in your direction. That is something that most retail traders, they face. This is an issue that they face each and every day. Fortunately, with this framework, you're not going to face that anymore. And actually, Nikki and I, we have a group, like a mentor group that we work with. So we work with students over like a 12-week period to really teach them this framework in detail and everything. And this is one of the things that the big things that they feed back with is that ordinarily, some of the positions that they would have taken without this framework that we're about to show you here, they would have lost money. But now they're in the position where they're making money consistently. So everybody in our group, so when we do these programs that we run over 12 weeks, every single person ends up making money consistently. And the big thing that they say is that with this framework, it allows them to take positions and let their positions run. Right, let their profits run and not be shaken out of the market by silly little sort of like moves going against them, little moves going against them that isn't really in the direction of the longer term bias of the market. Okay, but we're going to give you this framework right now, so have no fear. Sit back, strap in, get a pen and paper, because this is where the magic really happens. So the framework. To enjoy long-term success in the markets, a trader needs to have an easy-to-follow framework that covers the following. You have to have a process to determine the direction of the market. You have to have a way to value the assets that you are trading. You have to have easy to understand entry rules and a well-structured trade management system. And all of the above should be as objective as possible. All right, and our framework is built on these 4 pillars right here. So let's go through the framework. So the first thing that you have to do is determine the direction of the overall market. Now, what you're about to see is that the direction isn't everything, okay? So you can make money even if we get the direction wrong, but having the direction right is a good thing because it will allow you to take your trades into profit that much quicker, okay? And when we get the direction wrong, a lot of the time we can make profit, but there will also be times when actually we might need to take a loss or we might need to get out at break even, all right? So even though not the direction isn't everything, having an idea of where the markets are headed will make your life as a trader a lot easier, okay? And will mean that you don't have to sit in your trades for too long. So how do we determine direction? Well, the first step is to develop a directional bias on the market. And you can do this via a number of different ways. You can use technical analysis, you can use indicators, you could use fundamentals. So some people will determine the direction of the market using like a moving average crossover system. One that you could use is you could apply a 10-period moving average and a 100-period moving average to your chart. And when the 10-period moving average is above the 100-period moving average, and the price is above the 10-period moving average, you could say to yourself that you're in a bullish market, the market's moving up, so therefore you're looking for long opportunities. And then if you were in a downwards moving market, you would need the 10-period moving average to be below the 100-period moving average and the price to be below the 10-period moving average. So that's the way that you could do it using technical analysis or indicators. We've actually found that following the fundamentals often leads to a more reliable view when it comes to the long-term direction. And although this seems like really daunting, there are actually only a few economic indicators that matter. And the one that matters the most, so the one that really drives it, is the interest rate differential. Now, the mid to long-term direction of the currency markets are driven primarily by the actual or the expected interest rate differentials between countries, okay? If you look at a currency chart with interest rate differentials applied to it, you'll see that there's an uncanny correlation. So once you have a view on interest rates or the interest rate differential, you'll then have a view on the longer term direction of the market. And just to prove this, if you look at the chart on the right-hand side, you'll see that we've got 2 lines on that chart. So this is a New Zealand yen, okay, chart or exchange rate, which is the orange line, overlaid with the blue line, which is the interest rate differential between New Zealand and Japan. And what I want you to see is that when the exchange rate is decreasing, so is the interest rate differential. If the exchange rate is moving sideways, the interest rate differential isn't moving anywhere. If the interest rate differential starts to drop, so does the exchange rate. Okay, and that shows you the relationship between the interest rate differential and the exchange rates. And now the question is, well, which one leads which? Okay, and the truth of the matter is that anyone can lead anyone at any particular time. But if you have an expectation on the interest rate differential, which is actually easier to get than it is to get an expectation on the direction of the currency markets, then you will have the direction of the currency markets, because eventually they're both going to move in the same direction. So really your job as a currency trader is to try and get a bit of an idea as to which way the interest rate differential is going to go between two economies. And the way that you can do that is actually easier than it sounds. So you can look at things like, you can look at the interest rates that they are now historically. So you can look to see a bit of a trend between the interest rates and the differential. And then you can read the central bank meeting minutes. So every single central bank, all right, will release meeting minutes each and every month. So to do with their interest rate meetings, and they will tell you, what they did, what they talked about, and where they think their interest rates are going to go in the future. You marry those two up against each other, and then you'll have a view on where the interest rate differential is going to go. It's really as simple as that. Now, the other thing that's going to drive the direction of the markets, okay, in the short term is going to be market sentiment. So whilst the mid to long-term direction is determined by the interest rate differentials, we still have to be mindful of the short-term momentum moves. So market sentiment. And this, I'm talking about things like what's in the news. So COVID vaccinations, Brexit, elections, natural disasters. These things are going to have a short-term impact on the direction of the trades that you're in. And the reason you're going to want to pay attention to this kind of thing is because it's going to allow you to time your trades a little bit better. Whilst timing isn't everything, so we've already talked about the fact that you can still make money if you get your entries wrong, if you time the market wrong. Just, getting timing right is just going to make your life that little bit easier, because it will mean that you're in trades at the right time. So they kind of move to profit a lot quicker than if you just got into a trade at the wrong moment. Okay, which from a psychological perspective is obviously a little bit easier. So whilst even if you get your timing and your entries incorrect, you can still make money. You can still, have a positive return in your trading account. Timing the markets and getting the right direction is going to make your life that little bit easier. And that's why we look at this. The next part is valuing the assets. So in order to make money, we must have an understanding of whether the currency pair we're trading is cheap or expensive in relation to its potential future value. All right. And what you've got to think about here is are you buying something today that in the future is going to be more expensive? Or are you buying something today that in the future is going to be cheaper? Oftentimes when we're trading anything, we try to overcomplicate it, right? We throw a bunch of indicators onto our charts and we look for all of these complicated setups. And we start getting away from the fact of, well, is what I'm buying cheap or expensive in relation to where it's going to be in the future? And to kind of give us a little bit of context around things, we utilize a trading grid, right? So we have a trading grid to help us determine the value of the currency pair that we're trading. And the idea is really just to give it a bit of context, to understand where the recent highs are, where the recent lows are, so that we can determine whether the current price is high or low, relative to the recent highs and lows. And taking this approach, we're able to benefit from the general volatility of the markets without the need to be super targeted in our entries. Because if we can generally understand that, the market is cheap compared to where it should be or where it could be, then we can buy now, knowing that at some point in the future, if we are trading small enough position sizes, some point in the future, we're going to come into profit. It may not be tomorrow, it may not be in the next few days, maybe it's next week, maybe it's in a few weeks' time. But essentially, if we get the overall direction of the market right, we're going to make money. And the aim of using the grid is really to move timing from the equation so that we can make money in two of the three market conditions that a trader is going to find themselves in. So if the market is trending in the direction that we believe that it should trend in, we'll make money. If the market is moving sideways, then we'll still make money. If the market moves against us, using our framework, we'll be in a position where we can mitigate our risk and at least kind of not lose as much, and in some cases come out with break even. And that's the power of utilizing the grid. So how do we apply our grid? Well, the grid consists of 4 levels that create 3 separate price zones, okay? The levels should take into account key levels and recent structure highs and lows. So the highs and lows of your chart, if you look at any swinging chart, you're looking for the highs and lows of the chart. And what you're looking to do is sort of like bracket the highs and lows. So you put, a resistance level at the top, a support level at the bottom of the major highs and lows. And then in between, you would have 2 other levels. all right, which will create 3 price zones. So and the distance that you want, so this gives you a bit of a guide. The distance that you want between your different levels, okay, are going to be roughly 4 times the daily average true range. The average true range is how far does a market go from high to low in a particular day. All right, in any charting platform, you're going to get the indicator that you can just apply to the chart that will give you this number. So the grid levels, so between one level to the next, you're going to want it to be approximately 4 times the daily ATR. So if the pound dollar, for example, has a daily ATR of 50 pips, our grid will be roughly 600 pips from high to low. Why is that? So 50 pips times 4, all right, is 200. So the 200 is the distance between the various different levels. We're going to have 3 different price zones. We're going to have 4 levels on our chart. So 1 at the top, 1 at the bottom, 2 in the middle. All of that all together is going to equal a grid of 600 pips. And if some of this gets a little bit confusing, please remember after the webinar here, that you can ask us any questions that you want. So, if following this workshop you decide that this isn't so clear, drop me an email. All right. Obviously, we've sent you emails for you to join this workshop right here. So just reply to that email, drop us an email, and ask us any questions that you want. So if you want more clarification on these things, ask us a question, and we'll be more than happy to help you. Okay. So getting back to the application of the grid, the idea is to build positions in 2 of the 3 price zones and unload them in the 3rd. All right. So for example, if I had a long bias, I would look to buy aggressively in the lower 2/3 and apply caution in the upper 1/3. All right, that's the way that I would do it. If I had a short bias, then I would sell aggressively in the upper 2/3 and then apply caution and perhaps close, book profits and stuff when it gets towards the lower 1/3. Now, entry rules. Entry rules are there to provide you with an objective way of entering the market. They are not the be-all and end-all of our trading approach. They just provide a catalyst for taking a trade, okay? Entry rules, like the way that we view them is, as I said, it's just an excuse to get involved in a trade in the direction that we already know that the market is going in. We need some sort of structure around our trades, and that's what entry rules are there for. They're not there to be super targeted, laser targeted, so that you're not going to ever see your trade go underwater. In fact, the basic premise of the system is that we're going to be wrong on our entry initially, but our trading framework will allow us to make money even if we're wrong on our entries, which is why entries are not the most important thing at all. All right, so the truth is that you can utilize pretty much any trading strategy with this approach. Your trading strategy is secondary to the grid framework trading approach. Now, my preference has always been price action based strategies. So I like to enter the market at support and resistance levels based off of price patterns. But you can use something that works for you. The key with any entry strategy is just to ensure that you're able to consistently execute it, because the long-term success will be determined by the consistency in every aspect of your trading. Okay, so you have to be consistent in whatever it is that you do. If you want a specific set of rules for entering the market, okay, then what I'll do is I'll tell you how you can download one of my favorite entry strategies at the end of this webinar here. Okay, so when we get to the end, I'll tell you where you can go to get a download of the entry strategy that you can apply to this framework, as well as being able to actually download this presentation itself. So if you think that's going to be useful to you to be able to have this presentation, to make notes on and things like that, at the end of the workshop here, I will give you the download link so you can run away there and download the information. Now, trade management, probably the most important part. Understanding what to do once you're in a trade is probably the most important aspect of our trading framework. All right, we don't like to leave anything up to chance and like to be in a position where we can be making money in more than just one scenario. I hate being in a position where I can only make money if the market goes in my direction immediately. I like to be in a position where the odds are firmly stacked in my favor, and using this trade management system, it does that. So the way that we do this is we no longer look at individual trades, but rather we look at a portfolio of positions that allows us to express our view on the market. Okay? A single currency pair can accumulate up to 3 separate positions, and these positions will be carried without a physical stop loss. I know. Without a stop loss? What am I talking about here? Am I going mad? No, because everything that you've heard up until now, right? Everything that you've learned, if you've been around the markets for a while, is have a positive risk reward. Always have a stop loss in place, la, 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 la. But you've got to ask yourself, how many of those people are successful? How much money have you lost trading systems with a positive risk reward? So if you can lose money with a positive risk reward, then it must be possible to make money with a negative risk reward, right? And this is what this framework is built around. And we don't just do this arbitrarily. We've built this framework after, hours and weeks and months of study of the markets, of the dynamics of the markets. What we were talking about right at the beginning of this webinar here, where we talked about the fact that the Forex markets don't trend, that there's a reversion to the mean type dynamic about these markets. This particular approach, what we're showing you in this workshop, is all built on that premise. So it's not there arbitrarily. I know that it's something that's going to be a little bit hard to stomach at first, but I promise you, this is the way to consistency in your trading. The idea is to benefit from the random volatility of the markets without having to be right on the short-term direction. We want to avoid those situations where we're right on the direction, but lose money due to our poor timing. So what we do is we maintain a portfolio of trades, and the maximum risk on any portfolio is 3%. Okay, this is your theoretical catastrophic stop loss, because in reality, you'll only ever be taking losses of 1.5% at any one time. Okay, and oftentimes it will even be less than that. But these are kind of like catastrophic stop losses. But what you can see here is that we apply our stop losses according to the grid. So we work out what is 0.5% from one grid level to the next, and that's kind of like will help us with our position sizes. Okay, so we want to make sure that a movement, if we were to get in, for example, on that second level from the top there, and the market went against me by one level, that needs to be equivalent to 0.5% risk in my account. Okay, so if I'm trading with a £1,000 trading account, for example, then a move from one level to the next shouldn't cost me more than £5. A move from the top to the bottom, which is 1.5%, shouldn't cost me more than £15. And obviously, if you're trading a larger account, then that number will be larger. But we're just applying this in terms of percentages, right? So 0.5% from one grid level to the next, which means if you accumulate 3 positions, so you accumulate 1 in each and every level, so the market just goes against you and goes against you and goes against you, which doesn't happen, by the way, but let's just assume that it does. So if the market goes against you and goes against you, what's going to happen? Well, your maximum risk will be 3%, but it doesn't do that. And if let's say, for example, if you look at this chart in front of you, obviously this market is moving upwards, right? But let's say that you wanted to become a seller. So the way that we would do this, imagine that you got into a position over here. So the market at this point, I don't know if you can see my cursor here. So the market is pulling back and you decided to sell the market here. The market then goes against you. You would add another position up here. And when you add another position up here, you wait for the market then to trade to the next level. When the market gets to this level, this second position that you're in over here is in at a profit. This first position that you entered over here will also be at a little bit of a profit, maybe break even, but you'll be able to close both positions for a net profit. And this happens again and again and again. So clearly this is an upwards trending market, but even if you were a seller in this market, trading the approach that we've given you here, you will be able to make money. Of course, if you're a buyer in this market, then it's even easier to make money. But even if you were a seller in this market, so you got your direction wrong, you got your entry wrong, you should see that you should be able to make money in this market according to this framework. Again, if you've got any questions about this, you need some clarity, please feel free to reply to one of our emails and ask us the questions. We want to help you, get to a point where you are consistently profitable with your trading. And we truly believe that this framework is the way to do it. It's the most powerful one out there. So let's just recap, on the rules around our trading approach. 1, you have to determine the direction. We use interest rate differentials to determine the direction. 2, you have to value the asset. Is it cheap relative to where it's going to be, or is it expensive relative to where it's going to be in the not too distant future? And then we use a trading grid to do this. And then we have our entry rules, and you can apply your favorite entry strategy here. Finally, we have our trade management. Okay, so we diversify through multiple positions. Okay, if you've got all of that in place, then you have a framework and you've got an approach that will allow you to be consistently profitable trading the Forex markets. And again, just to give you a little bit of confidence, this is what one of our other students wrote about this framework here. So they said, trading the ACT method is unlike all of my previous trading approaches in that I feel I have a solid overview of the current markets and a straightforward plan of action before I even open the charts to find trades. Using the scorecard and the grid, so we're determining the directional bias and we're valuing the asset here, plus the simple filters takes practically all of the stress and negativity. That's the second person I've shown you that says about taking the stress out of the equation, the stress and negative emotion out of the situation. And I have confidence I have never experienced previously in all the trades I place and my ability to manage and make a profit from them. The pleasure has come back into my trading and I'm feeling positive about making a sustainable second income for myself over the long run. And that there, my friends, is the power of trading according to this framework. Now, I mentioned earlier on that if you wanted to get the entry strategy and if you wanted to download this presentation here, I would give you the link for the download. All you have to do is go to www.tcmarkets.co.uk/download. That's www.tcmarkets.co.uk/download. And on that page right there, you will have a link to be able to download the information. So the presentation and the entry strategy that I talked about in this presentation here. So I hope that this makes sense to you. Again, if you've got any questions, we are always there to answer them. All you have to do is, reply to one of our emails, pop us a question, and we will always do everything that we can to help you make money trading the Forex markets. Okay, so what did you think of that? Eye-opening, right? Don't worry if it's a lot to take in. I promise you, once you've had some time to process that information and perhaps to do a little bit of testing for yourself, you'll see how powerful that strategy and that framework really and truly is. But before I go today, I want to take a brief moment to talk to you about a new approach that Nikki and I are going to take to the Forex education market. And that is an approach that is going to align our success with your success. You see, we want to make Forex education, proper education, and profitable strategies available to everyone. You see, if you wanted to get coaching from somebody with, let's say, nearly 2 decades experience in the financial markets, somebody that successfully run an investment firm before, you'd be looking at paying ridiculous sums of money. In fact, courses these days, programs, mentorships, they're going to cost you upwards of £1,000, and some of them much, much more than that. But we decided that a better approach might be an approach where we align our success as educators with your success as a Forex trader. Now, what do I mean by that? Well, ordinarily, when you pay for an expensive course, you pay for most of the course fee, if not all of the course fee, up front. And what that means is that whether you're successful in the long run or not doesn't really matter to the person providing you that course. Sure, there will be people out there that want you to do well and will do everything that they can to make sure that you are successful, but essentially your goals don't align because they've already taken your course fee up front. They will do everything that they can to help you, but there's not that same incentive there to make sure that you are successful if their success as educators was pinned to your success as a Forex trader. So what we thought we would do is we would take an approach that was entirely different to that. We want to provide an approach where essentially, if you're successful as a trader, we're going to be successful as educators. So we thought to ourselves, what if we put together a mentorship, a mastermind group that not only stood head and shoulders above everything and anything else out there in terms of content, coaching, strategies, and ultimately the results that you're going to get, but also all but eliminated that risk of having to pay everything up front and then being left to fend for yourselves when the educators obviously got their course money and you're still trying to make a success of this business. Well, that's exactly what we've decided to do. So we would like to invite you to join our Pay on Success Forex mentorship. Now, what this does is all but guarantee your success. In the first month of this mentorship, you're going to get access to our video tutorial library, where you're going to learn everything that you need to know to be successful trading the Forex markets, including our proprietary trading approach that stacks the odds in your favor. You're also going to receive an invitation to join our weekly webinars, where you can come and ask any questions that you have about the course, as well as any questions that you have about your trading in general. In the second month, you'll get access to our Forex Trading Discord group, as well as our Currency Intelligence dashboard. Now, what this is, the Discord group is a way to interact with us on a daily basis. So you can ask us any questions about your trading, the trades that you're in, perhaps, on a daily basis, and we will give you our opinion. The Currency Intelligence dashboard is where we will do all of the analysis for you. So we will analyze 28 different currency pairs to tell you what our view is on the direction of that currency pair, and also which way we're looking to trade it and how we're managing our positions. You see, with the Discord group and the Currency Intelligence dashboard, what we're essentially going to be doing is we're going to be trading alongside you. Okay, so like I said, we're basically going to be tying our success to your success, because you're only going to want to stick with us in this program if you're successful trading the markets. And the best way that we can do that is not only teach you the framework that you need to be successful, but to actually work with you to show you that it works in the real life markets, not just with our accounts and our trades, which we will be showing you, but helping you trade your own account to make sure that you're successful trading your own account. Plus, you'll be able to interact with other traders who have also gone through the same program as you and are currently making money trading the same trading framework and the same trading approach as you. And I know that this is a very important aspect of it, because I can tell you that we're successful as much as I like, but I've got a lot more experience than you. It's much more motivating and inspiring to see people that have been in your position that are actually making money trading the same way that you're learning to trade, which is why that part of it is also very, very important. So the question is, well, how much is this going to cost? And the good news is that, as I said, we're tying our success to your success. So there aren't going to be those huge upfront fees there. All you have to do is pay £249 today to secure your place. Once you've done that, you'll get immediate access, as I said, to all of the course material, as well as an invitation to our weekly Forex webinars. Then, if you feel like you are seeing success in your trading, if you're starting to see things change in terms of consistency and things like that in your trading, you can continue with us on a month-by-month basis for just £249. Now, it may be that in the first month, you learn everything that you need to learn. So you learn all of our framework, you learn the information, you get the course, and you think, I can go it alone. And that's absolutely fine. You can cancel after the first month, and then you would have paid only £249 for what essentially is worth, many, many thousands of pounds. Or you may decide for yourself that actually, yes, I know the content and the material, but I'd like to benefit more from working with Alex and Nikki on a day-to-day basis to really sort of understand how the markets work in real time, and get coached by them and sort of learn everything else that there is to know about the markets, in which case you can continue with us on a month-by-month basis. And as I said, our success is tied to your success. So you're only going to stick with us if we continue to give you valuable information that's going to help you make money. You see what I mean? So this is a way that we want to change up this industry here. Yes, obviously we want to make money as an education business, but we feel that if we provide great content, if we help you make money trading these markets, then you're going to be more inclined to stick with us and stick with our services. And if we can't do what we say we're going to do, then obviously you'll cancel. Okay, so our goals are now aligned. So if you're interested in this, all you have to do is click the sign up link below and join the program. Once you've done that, we can then get together and start working on your success as a Forex trader and getting you profitable and making money as a Forex trader. So that's all you have to do. Sign up below, join the program, and start working with us to take your trading onto the next level. Thank you so much for watching, and I truly hope that we'll be working with you very, very soon.